Thank you all for joining us. This is one of my favorite topics. I covered technology before I covered finance, and now I get to mix them both together. So, I think the first thing I want to talk about here is, we're talking about the rise of machine learning in asset management, but the rise of machine learning has been happening for a while. And Tobias, you've written about this pretty extensively. What are the limitations, perhaps? Let's start with the limitations before we get to the opportunities.
All right, I'll start with the negative stuff, right?
Let's get it out of the way.
Yeah, exactly. Well, no, I mean, it's a great tool like any other tool, but it has its limitations. One of which is, that it's really applied to big data. And I know we think we have lots of data in finance, but our outcome variable, which is prices or risk, is really not that large. We don't have billions and billions of data points to predict. So there are some limitations. The other thing that's limiting is no other market is as competitive as financial markets. So when you do get an edge, right, it doesn't stay there forever. It gets competed away very quickly. So as a quick example, machine learning can recognize a cat from another animal, right? But as soon as it starts to recognize it, it's not like a cat changes itself and camouflages, right? Financial markets are constantly adaptive, which makes it challenging. But that's the negative side. That's the limitation.
There's a reason I wanted to get into this, because I knew Julia would be able to refute it. No, but really here, what are the things that you see are the most promising when it comes to machine learning and investing?
Well, we've been investing for over 6 years. We have a 5-year track record, and you don't need a lot of data to produce a valid signal. And Gareth and I were just talking on the way in that we must be taking advantage of the inefficiencies that are being created by large asset managers, because we're seeing returns and demonstrating that it can be done.
It's interesting. The other reason I kind of wanted to start here with the limitations is because I think we'll spend the next however amount of time talking about how we break some of those areas down. Gareth, when you think about the way machine learning has changed the way that you do your job, what is the most significant change you've seen in the last couple of years?
Yeah, so it's changing very, very rapidly. And I genuinely believe, after being in this specific field for the last 12 years, it's never looked like it has now. So we're entering a Netflix blockbuster moment for investment managers who either kind of get it and move into adopting these new suite of tools, right? I'm not just talking machine learning. It's much broader than that. And the folks that decide not to, and the transition is underway now. So it's changing literally every part of the value chain of active investing right now.
So when you talk about machine learning, I think a lot of people think about, okay, how is technology transforming investing? One big question is AI. AI is supposed to transform every industry. At what level does AI and kind of this new conversation, this renewed conversation around natural language processing in particular, generative AI, how is that changing how you think about the way things are moving?
Yeah, so it removes a bunch of friction, right? There's a lot of friction between useful insights in the data and in entirety of human knowledge, which has been codified, and folks that need to access that insight. So just as we were sitting here 20 years ago talking about search, it's kind of the same paradigm shift. So it removes a lot of friction, everything from client reporting to analysis, to looking at different events, looking at sentiment across the board. And by the way, I'm the last person to be hyperbolic about this stuff. I would love to be the curmudgeonly contrarian that says, this stuff is just a fad and it's hype. But we've been watching it a long time, and there is a lot beneath the killer app of the GPT models that's kind of got the world excited. The thing about a killer app, if you can remember back to the late 90s of that language, it's what's beneath, what it reveals beneath the killer part, which is the story. So all of the models are ready, the cloud stack is ready, data is where it needs to be, it's go time, and it's changing the face of investment management rapidly and in a good way. Fees down, less people, less friction, better returns, more customization. And why the hell is that not going to be the world we're going to live in? And why shouldn't it be, frankly?
It's funny that you say that this is kind of the Netflix moment when you think about quantitative investing, because, think about AQR. You're just coming off of, a record year in AQR's history. I mean, a dozen funds had record performance last year. So why would this then be a Netflix moment? What is really changing about the way you do your job that could maybe amplify what you do in the future?
Well, I think this is where some of the big benefits of using AI and large language models comes into play. It does give you access to data that we didn't know how to quantify before. So take textual data, or as Gareth said, sentiment. You can use machine learning techniques and AI to extract signals, to codify human language in a way that gives you insights that you could never get before. And I wouldn't say that has completely changed our models. We still do what we do, but it's enhanced them greatly, and it helps us think about it. And this is just, I would say, we are beginning down the path of this. I'd say it's more of an evolution than a revolution, but that's because we're just beginning this. There's a lot to do, and we're learning so much more.
Julia, maybe drill into that. What is there actually to do? What really changes about the industry as it evolves?
Well, when you think about performance and you're breaking down 50 years of academia, asset management is still trying to use machine learning to create better factors. A lot of the research that you're seeing is going in that direction. But AI unshackled has much more potential to extract nonlinear features from data, which means alpha. I mean, there's a lot of asset management products out there that are delivering beta, but if you want to pay for active asset management, you should be expecting and receiving alpha.
I actually would love for you to drill down on that a little more, because there's this conception lately, particularly among a lot of asset managers in the private space, that would argue, Apollo has argued this, that alpha is being ripped out of public markets. So to what extent does machine learning technology really help squeeze out alpha for asset managers?
Well, machine learning, again, is an umbrella term. So any sort of classical linear regression, for example, that's been used to develop factors is machine learning. But we use neural networks, and neural networks are inherently nonlinear. So that means they look at curves instead of straight lines. So that is the way that you extract new information from data, whether it's natural language processing, whether it's extracting from pricing data, numeric, et cetera. So there's all sorts of opportunity, because there's still a mindset out there that you have to have a human in the middle in order for this to work, and you don't.
So that's the second time the idea of humans doing this job has come up. You had mentioned jobs, Gareth. I mean, to what extent do jobs start to be reduced in the asset management industry at a greater scale because of what we're seeing in advancements in technology? What jobs go away?
Yeah, so this is a hypothesis, right? But this is the way that we see the future of the business. An easy analogy is, think about the last airplane you flew, right? There were two human beings in the cockpit, and there was a flight management system that actually they called George, which is largely AI. Go back 50 years, there's some folks in the room that might remember there was 5 or 6 folks in the cockpit, right? Navigator, a couple of engineers. So asset management is going to go that way, right? Increasing role of machine, decreasing role of human. But I'll add one layer. This is the thesis part, which is, I think, exciting. The need for the best humans to be in the cockpit or in the room is even more critical, right? You want a Captain Sully flying your US Airways when you hit a bunch of birds and the engines blow out and you need to land in the Hudson. You need a Captain Sully. You don't want an AI trying to deal with that edge case. And so it's a very trite analogy, but there's depth to it. And if you're able to marry the best of the human with the best of the machine, particularly in long-term investing, fixed income and active equity, that's the way to investment heaven for the future, in our view.
So what does this look like from your perspective at AQR? Has it changed not just the amount of jobs, but frankly, the texture of the jobs? Do you need to look at people with different talents in the financial industry than you had in the past?
I think so. I think we've always gravitated towards, obviously we're a quant shop. We've hired quantitative analysts and people with quantitative skills. Those skills have evolved for sure. And I think something that Gareth raised I thought was really interesting. I think of these tools as something that leverages human capital, right? So you're going to need the competition right now for the best talent, I think has never been more fierce because you can leverage that talent with all these tools that are out there. So what you can do with machine learning today in terms of sorting through the data and testing models is so much faster than it was even a couple years ago, let alone 10 years ago. So you need fewer people to do that, but they can spend their time really thinking. So I don't think humans, I think, are actually more necessary today because of these tools. But it has to be the right humans, right? You can really leverage their time. Much like, think about an editor. They don't spell check anymore. They don't need to, right? They can do other things. Well, you have tools to do that now, right? So, but that's the similar idea. And I think that's where you're going to see the jobs changing. There's going to be a lot more competition for them.
How do you see this playing out, Julia? When you look at people who are entering the workforce, what maybe don't they have in their toolkit that they may need? And how has your career kind of changed given that this industry has been so fast moving?
Well, capital flows where returns are. So, there's truth that you are going to need skill sets in terms of, obviously there's coding and, that doesn't just turn into Skynet, hopefully. But where the tool set is changing is the skill is going to be able to leverage itself, as Tobias is saying, much better. But the opportunities in terms of opening up asset classes and gathering information and automating a lot of the processes that were inherently in place. I mean, we have an extremely efficient asset management firm from a corporate structure because we've been forced to automate everything. Now, we obviously have eyeballs on everything, but when you think about an old school asset management firm that has had to add people in order to scale, you don't need to do that anymore.
Now, I want to talk a little more about areas that maybe have not been touched as much by machine learning, by quantitative analysis. There's a sense that equity markets were easier than fixed income markets, and the CTA markets had been trading futures for a very long time. So what is still difficult to tap into, do you think, Gareth?
Yeah, the more you move down the illiquid spectrum, the harder it gets. So you could actually start with super long-term growth investing where you might need to have a qualitative thesis driving you, and then obviously you move into privates and real estate and private equity and venture capital. So you move in that direction, then AI is an assistant to you, but that's further down the track.
And Julia, do you think that there's kind of a next vantage point, like a next frontier here of a market that now with all of these new technologies that are coming up, particularly natural language processing, that will be more disruptible now that we have more tools?
Yes, I mean, when you start thinking in the last panel with blockchain, right? When you have provenance, when you can literally extract information, because blockchains are mostly public, all of that information is capable for training so that you can make it predictive. So depending on the problem you're trying to solve, there's a lot of opportunity in terms of how to use AI, and I think particularly neural networks, deep reinforcement learning, which is some of the foundation of generative AI.
And to what extent are you doing that right now?
Well, we're using neural networks completely to manage our investment strategies.
As far as blockchain goes?
Well, blockchain, we've created a Bitcoin and an ETH strategy. So we extract data from blockchains to train our models.
How about you? Where do you think that, I know AQR was early in the fixed income world also to kind of use machine learning, so where else can?
So we'll use it wherever we can and wherever it makes sense, and I think a lot of it is data driven and where as Gareth mentioned, but I want to say another place where I think it's going to be used, where everybody thinks of these applications as using them to search for alpha, which is something it's the first thing everybody goes after, but they're actually really useful, I think, for measuring risk, for thinking about trading. Think about trading for a second. You have much more data there, right? When you just think about the orders you're putting out there, there's an ability to learn from that. A lot of nonlinear relationships as well. That's something that I think people haven't explored that much, and something we're interested in doing. And on the risk side, whether or not you want, beta is not bad relative to alpha. It just depends what you pay for it, right? But also knowing what your betas are is critically important. And these tools can be very helpful with that. Maybe more, I would argue, more helpful than finding alpha, actually.
Well, what are some examples of how you would use machine learning technology, AI, to risk manage better?
Yeah, I think the hardest thing with risk management is, we can measure the risks at a point in time, but we don't know how they're going to change. They're very hard to think about, especially big jumps, right? So to the extent that you can do things to make your system more robust, that it can either adjust when things start moving one way, or you can measure the risk in advance, that's incredibly valuable. And unlike alpha, it doesn't get competed away, right? So the signal to noise is much lower, or much higher there for risk. I think there's potential there, but we're in the early stages. That's something that has not been explored, not just generally, but in academia as well. It's just beginning.
I'm going to ask you now, because I've asked everybody else. What is not possible? You had mentioned some of these more illiquid strategies, right? Can you ever make quantitative private equity? I know AQR has tried, but
Thought about it.
In some fashion.
Yeah, I think the limits of what's possible is because you have to at some point interact with a human being. So you could say the best pilot is AI and the best medical doctor is an AI and all of that. But ultimately, if you get a cancer diagnosis, sorry to get grim, but you want a medical doctor there somewhere in the loop. So I think that's a major constraint. And actually, the thinking on this has shifted even in 6 months, understanding where these models are going, because you could have a credible view maybe 12 months ago that we're going to be entering a robo-type world where a lot of things are automated and there's not a lot of need for humans and you're going to lose all these jobs and all that stuff. But you cannot say that anymore, because it's very obvious that these tools will become little mini co-pilots, assistants for all of us in all of our jobs. So there's a massive positive story here. There is a slim chance things go very bad, as Elon and so forth keeps talking about. But the major story here, these are specific tools that all of us can help make our productivity that much better. And the limit is just the human element. It's not so much what the machine can do. So a quick shout out, steal 10 more seconds. The last thing to say, which is exciting, is you need to, in the past, you needed to be like a nerd like me that can code and does engineering, right? You needed to learn this new language to interact with these tools. It is no longer the case. GPT has leveled the playing field. There are low-code, no-code solutions. You don't have to even know that Python's not a snake, it's actually computer code. You can have GPT help you code. So it means it democratizes it for all of the functions that people have, whether it's risk management, on the investment decision-making side. You no longer need to be the quant in the room to actually apply these tools. And that's the coolest thing, and that was not understood 12 months ago.
I am still going to make you double down on that idea, because I think when it comes to GPT, there are still some skepticisms about how it would be applied to finance. How are you using it now, and how are you using it?
But how could you not use it? Like, what's the other argument?
I've heard traders using it to plan vacations and write investor letters, but are they using it to put money to work?
Like, if I walk past a construction and there's a nail sticking out, and then someone gives me a hammer, I'm going to use it. Like, it's a very powerful tool. It's only just beginning. Of course, there's kinks, and it's still in beta form. But it's a very, very powerful tool that we add to our toolkit and into the mix. So there's no doubt this will be a bigger conversation next year.
I'm curious about the blockchain element of this a little more, because so many firms are using blockchain to potentially tokenize different assets. I'm wondering what that would mean for the way you invest. In theory, you can see a lot more transparency in markets that were previously far more private, and therefore be able to apply a lot of the techniques that you've been talking about.
That's true. but I think it was Howard Marks that said your instrument is only as liquid as the underlying instrument underneath it. So you still have to be mindful that illiquid investments are indeed illiquid, even if you tokenize them. And so you don't want to turn them into a Ponzi scheme. So, you just have to be aware of why you're tokenizing something and does it make sense, and what's the underlying capital underneath it, that you're not, leveraging something that shouldn't be leveraged.
So even blockchain would have limitations in terms
A
of...
token is a security, or I may not be supposed to say that, but it is. And so if you're trading something, it's because there's something underlying value underneath it. And if it's not there, then you're just trading something.
We've talked a lot about different types of technology, machine learning, AI, generative AI, ChatGPT. I'm wondering, how do you kind of parse through the noise here? When you think about the technologies that are most important to the way you invest, what are you actually using? And by the way, using in the sense that things you need to know and things that people are not doing for you, as you say, that are happening now in finance.
So you mean, what do you need to know from a research perspective, or just from...
what's exciting to you?
Yeah.
I mean, the idea, we've been talking about the rise of machine learning, but, people are talking about a lot of other things that are newer in finance, blockchain, AI, we've talked about this before, quantum computing. What does that mean when it comes to disrupting different industries, let alone finance? When you're thinking about what's most important to what you do day to day, what is it?
I think the most exciting thing for me as a researcher is, if you look at in human history, right, we've created more than 90% of data in entire human history in the last 2 years, right? And that's been true every year. So every year we're creating exponential growth in data. Most of that data, however, is unstructured. It's in the form of text, audio, video files. These are things that, as quants, traditionally we didn't know how to quantify. We need to convert that into zeros and ones and quantify it somehow. So what I find most exciting is these techniques give you a chance to do that, right? So you mentioned ChatGPT, but really what we're talking about are large language models, right? And what they do is they simply take the text, as one simple example, and summarize it in a set of quantitative variables that then you can use with any prediction problem. That's what's exciting. Now, we're not there yet with video, right? Because that's even more massive when you take all the pixels and all the data there. We're getting there. And this is not just in finance. You're seeing this in sports analytics. You're seeing this all over the place. But I think that, to me, that's exciting because it gives us access to something that we've never looked at before, right? Historically, it was accounting numbers and stock prices, right? That's pretty limiting. Now we have an opportunity to look at lots of other things. But to your point, we have to make sure that we're capturing truth or signal and not a lot of noise, right? Most of the textual and audio language that's out there is a lot of noise. How do you filter through that? That's, I think, a challenging problem, but one that's exciting.
I think that's worth doubling down on. It's kind of like one of the first things they teach you in quant school, isn't it? That the data can be wrong. And so, when you're looking at kind of this influx of data, so much that's been created, how do you sort through the noise?
Yeah, so the thing that's exciting us at Voya Investment Management, again, we have our small view on the world, but what we're enjoying is breaking down the silos between the three technologies that have emerged to help us do a good job as investment managers. We have the amazing quantitative tools, we have fundamental analysis from human beings, and we have these machine learning tools. We call them machine intelligence. So those three worlds are heavily siloed traditionally, but to the extent we can break them down and find the symbiosis between them, that's where the outperformance is going to lie. That's the hardest, that's the next mile. So that's what we're laser focused on. Data is super critical, but at this point it's so commoditized that it's really, as they say, what you do with the data that's going to matter. So we're trying to figure out how to make the best of those three technologies and have them blend together in a really elegant way.
How do you think about kind of this conundrum of too much data or unstructured data? And what kind of data are you using that has become more interesting to you over time?
Well, we have the luxury that we started from scratch, and so we went straight to neural networks. We didn't have to work our way through the chain of machine learning. So from a data perspective, we used what was available and inexpensive. And so we went to liquid pricing data to test our first models, and we were able to get them to generalize. And so we started from there, and we were very fortunate to have a large university endowment look at our results and say, that's amazing, can we do this? And we launched. So because of that, when we built a platform, and so when we build new models, we literally look at what markets we think are interesting and we build a model. So there's a lot of experimentation, but it frees you from the constraints of this can't be done or this can't be done, because when we show that we can do it, it just makes us want to try it with additional data. Now, as far as large language models, that's very interesting, because if you think about autonomizing a process further, to be able to type in, okay, I want to build a model, and then have it create and curate the data set, train based on the model that you've built, and then be able to go through the whole cross-validation and out-of-sample process. It could be done just by asking, and that's kind of where we want to take it. So
I think one thing that I enjoy about covering quants is because in finance, it's a business of risk management. You're kind of always looking at the bad. But with quantitative investing, on some level, you're worried about today, but you're also thinking, as you say, 10 years down the road. So, draw a picture for me. What does 10 years down the road look like?
Oh, I get to start? Oh, great.
You started, so.
I think you've seen this explosion in the use of these tools and their understanding. I'm seeing it, I teach at Yale, and all our students are double majors in something and computer science, right? I mean, that's what you see across the board. So everybody's investing in this technology on the human side. I think it's going to become more standard. I think even, forgetting about investing, but even things like, I wouldn't be surprised if in addition to spell checking on Word, you had now an editor called, whether it's ChatGPT or some other large language model, you'll see that. But I think we'll understand things a bit more going forward. There'll be new problems that arise too, right? I mean, you talked about the signal to noise problem. In our business, we have the toughest time because signals get competed away. So, markets aren't perfectly efficient, of course, but they're certainly very far from being totally inefficient, right? So because of that, you need techniques that are going to handle that problem. And one of the things I think we're always going to need is some structure. So whether that's economic theory, if you work at AQR, that's where it comes from. At other quant shops, it's going to be other kinds of structure. It could be a statistical structure or a fundamental structure. But you do need something to filter out that noise. I think that's going to be the biggest challenge. And in 10 years from now, we'll still be grappling with it. So better technology, but I'm not sure the problems will change that much.
Gareth, how are you seeing the industry to the extent that you see it evolving significantly over the next 10 years? You said we're in our Netflix moment.
Yeah, so this is a nice, easy question, because I know for sure I have no clue that what happens. And I know I don't know.
What would you hope for?
So, well, let me quote people that in a position to know. Last night, for those that were in the Steve Cohen session, incredible, and he spoke very much about AI and a potential positive future. So I hate to be the optimist, but the numbers are really interesting. If the US can return, this is a macro view, if the US can return to its trend productivity growth, which apparently is 2.2, 2.3%, if the US returns to that profile, there's an extra $10 trillion over 10 years of GDP. And that is possible if these tools end up resulting in even a modest improvement in productivity. So there's a macro world out there that this is kind of, as we were looking like we're in an abyss, there's a potential way out for this tool. So that's one insight. And then the second and last thing I'll say, super interesting. I saw a very recent interview between Sam Altman, the CEO of OpenAI, and the CEO of Stripe, a billion-dollar fintech. And Sam was asked, where do you think the most exciting application of this technology is? And he said it's in finance. First time I've heard that. So that is super cool. So between those two, they can predict the future. That sounds pretty cool to me. I think we're in a good place.
Julia, 10 years.
Well, I think 10 years from now, I think we should stop thinking about this as that we're replacing humans.
Yeah.
I think we should start thinking about that humans aren't replacing themselves, so this is going to bring much more efficiency into the marketplace, and it's going to provide opportunity for everyone. And asset management in particular has been mired in the same research for 50 years, and so it's time for disruption. It's time for exploring new ways to use AI, and neural networks, I think, are the future. They're used in every other industry prolifically except asset management, so it's time.
Do you think that it has the potential to make financial markets more robust in some way, given that, in theory, more data will be available and more transparency would be possible?
It definitely does. And as you think of the massive liquidity that we have in the market still, even though we've talked about the Federal Reserve trying to soak it all up, capital is looking for places to go. And so the more that you can deploy it efficiently, the better off everyone is in all markets. And so as this is used more, you'll see anomalies disappear, hopefully, but new ones will be created. That's just how markets work. So it's all very positive.
We only have a few minutes left here, but I figured, I'll give a chance for final thoughts, kind of down the panel here, Tobias. If anyone in the panel needs to have one thing to take away of how to think about the rise of machine learning in finance, what would you tell them?
I would say, think of it as a very, very powerful tool that is opening up a whole new areas of research. I think it is important to invest. I think we would all agree about that, to invest in this technology, its understanding. I agree with my fellow panelists. It's not going to replace humans, but leverage us to become more efficient in what we do. So I would invest in it, thinking of it in that way. If you think this is just going to solve all your problems and you can just, press a button and walk away, that's not the way it's going to work. So that's my final thought.
And I would just say that AI is unlocking alpha, and investors are searching for it. And in liquid markets, this is nearly the only place to find it. So this is going to be, the wave in asset management.
So yeah, don't be Blockbuster. You don't want to be on the bad side of a Harvard Business Review case study. That's not a good world. So let's be Netflix.
Is it like what A-Rod was saying earlier, don't try to hit home runs, hit singles and doubles when it comes to quantitative investing?
Yeah, exactly. Yeah.
Well, guys, thank you so much for your time. This was a really fun panel to do, especially at this time with so much change. Thank you.
Okay,
Thank you.
Thank you.